Hello. So today in this video, I'm going to talk about what is model risk and why we should learn about model risk. If I've already worked in risk management, I am quite sure you know what model risk is. If I've worked in banks and insurance firms, investment firms, you probably have heard about what is model risk. I'm not sure if you have ever thought about it, you have really worked on this or not, but someone who is really fresh and somebody who is new to quantitative risk modeling, it's important for them to know what is model risk. It's not often a risk that is talked about in the world of finance. It's getting a bit more attention nowadays, but it's still not getting enough attention or not as much of attention that it should ideally get. So, in risk management, you have different kinds of risk, right? You have operational risk, credit risk, market risk, fraud risk, country risk, and liquidity risk, interest rate risk, currency risk, and so on. So there are many areas of risk management, but one area which is an area in itself, which is called model risk. That means because quantitative models are used in many areas of risk management, whether it is in credit risk management, market risk management, operational risk management, or asset liability risk management, there are uncertainties around what could happen if something goes wrong in the models, right? Models are not always perfect. As someone said, all models are wrong, some models are useful. It's true also in the world of risk modeling, and the statement was actually given by a statistician or an econometrician, I don't remember, in the academia world, but even in the industry, it is true. And not just in the field of finance, even in other areas where machine learning models and statistical models are used, things can go wrong. And people seldom think about that. People only think about the performance of the model for the future. They are really happy if the model performs really well in the data that they are using for model building or in the cross validation, the performance is okay. They don't worry about what if something really goes wrong, something wrong in the input data, something is wrong in the model development itself. How will that affect the business, right? In the field of finance, that is actually given due importance. In other areas, in other industries, I haven't really heard much about people worrying about model risk, although I strongly believe that that should ideally be a concern in all kinds of industry that use models in any shape and form. So in the field of finance, regulators want you to give emphasis to the risk that stems from the use of models, and models are never perfect. Any modelers, anybody who has ever built a statistical, mathematical, machine learning AI model would tell you that the models have their inherent issues. The issues could be related to model assumption. It's impossible that the model assumptions are met in all cases, all scenarios, right? Models could be wrong because of challenges related to model methodology. Okay, data issues are very common, right? And it's not a problem with the models per se, but if the input data to the model is not correct, then things can go off, right? Estimation issue. Sometimes there are issues with estimating the parameters of the model, and that could also cause issues in the production, right? So understanding of the issues with the models extremely important if you're going to be working in any quantitative finance area, especially in regulated entities such as big banks, fintechs, and some of these sovereign wealth funds or hedge the pension funds using models, insurance firms, and so on, because these are highly regulated entities where any mathematical model that you build, you have to be really cautious about the risk that comes from the use of the models, and use can I mean, there are many examples where things have gone wrong. In fact, the 2008 crisis, right? Financial crisis of 2008, the global financial crisis, which happened for a variety of reasons, recklessness and so on. But one of the reason why it really went out of control is that nobody really assessed the model risk. There are many models used for valuation of assets, valuations of various kinds of assets, especially the asset-backed security (ABS), and in this case, it was mortgage-backed security. Many models are used for valuation of those assets. They were not properly valued. I mean, there were number of issues with the models used, right? Also, the credit risk assessment, right? People who know the credit risk modeling, the PD and LGD and the EAD models used for assessing risk related to loan default and potential losses. Uh, that also went uh, really off during 2008 financial crisis, and many people questioned the the outcomes from the models, and therefore many the quant finance world actually got a bit of a blame because of that, right? So the point here is that models can also be faulty, no matter how much uh, emphasis you have given on the validation side, on the audit side, how much emphasis you have given to ensure the quality is maintained. Regardless of all that, there are still challenges related to model. There are some known challenges, there are some unknown, right? Known issues, and there are some unknown issues, right? Unknown issues you cannot do much about, but there may be some known issues, and not all known issues can be resolved during the model building process. And by the way, most quants know about these issues. They simply overlook during the model building process. Sometimes uh, they get attention from the validators and the regulators, and in the process you get a finding an issue, and that would eventually be resolved. But there are many instances where people who are validating probably won't spot it. So it's good to already know what are the known issues in the models that you have built. It could be estimation issue, for example. You have ignored one particular assumption in the model. You feel that, okay, there's no way this assumption will be true if you are to build a model, right? Right, what some people do is that they simply change things and they simply ignore that, don't even write about that. That's lack of transparency, right? It can cause number of issues in the future, right? Data issues are mostly known, so make sure that you uh, put that in the document that you write, and 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 so that it's quite transparent to people. Also ensuring that people who use the models, they know how to use the models. People who use the models should know what are the limitations of the models, right? Especially in the case of trading and investment, you know uh, it especially trading and investment models, right? There may be instances where these models may not work, especially long-term investment models, right? Where you are not using models for everything, right? I mean, long-term investment models are, you use the outcomes of the models, but also you use your own understanding of the market for decision making. Whereas automated trading models, like the high frequency models, they're pretty automated, pretty algorithm driven. So there is little you can do in between the process. But the long-term investment models, there you can use your own knowledge to add to the outcome of the models, and then and then take the final decision in those kind of models, right? It's absolutely important to know where things can go wrong. So the one thing that you learn from model risk management is to clearly understand what could wrong with the models, and what are the limitations of the models. So understanding the limitations is absolutely important. And why is that important from a risk management point of view? Simply because that could result in losses, that could result in losses. And we have seen that in 2008 financial crisis. There are also other examples. I've seen models going wrong has resulted in billions of dollar of losses in a large bank. I think JP Morgan, also in Citibank. So if even a small mistake could cause enormous amount of losses for the financial institution that is using these models. Very important, therefore, to know where things can go wrong and see all potential areas where things could go wrong. From the regulator point of view, why model is important is because you also have capital set out for that, right? You have extra capital just to mitigate any potential issues with the models in the future, right? Because regulators are concerned about the public deposits, right? The public money, the deposits of uh, the common men, common people, right? And in order for the bank to ensure that they have enough capital for bad times, regulator enforce that you also keep capital for model risk next to uh, your capital for credit and market and operational and all kinds of other risks. Okay, especially in the field of credit risks, actually this is important. I think less in market risk and other areas, simply because in the credit risk area the data challenges are actually more. You simply do not have data for uh, many portfolios. For example, there are many portfolios where you simply do not have enough defaults to build good models, right? In those cases where even a couple of more defaults can really change everything, and that could completely make the model wrong. So prediction will be completely different in that kind of scenario. So very important, therefore, to assess that what are the scenarios where things could go wrong, and the model simply won't work, right? So what are the regulations around it? Well, in the UK, right? In the UK, the regulator there, the Bank of England is the central bank over there, and I think it has already the PRA over there has recognized model risk as a separate form of risk. I think in US and European Union they haven't really formally recognized model risk as one form of risk. It's considered a risk that is associated with all other forms of risk in the financial world, but this is only increasingly getting a lot of attention as a separate form of risk, something that the banks or all kinds of financial service organizations should worry about, right? Do private funds, trading firms, investment firms care about these particular risks? Many of them don't. Regulated ones do care about model risks, and they have their own risk management frameworks to deal with that. But I think trading firms don't care too much about model risk. I think it's also because they trade money from high net worth individuals or their own money, right? It definitely brings some extra level of risk. But I know for sure that at least I think at least I know one trading firm that has hired people dedicated for model risk management. So probably this is going to be more popular even in trading firms, but you won't find a job description in a trading firm that talks about model risk management. Right? But that's not the case at large insurance firm, large banks, or consulting firms, or fintechs. And those places, you will always find people being hired for model risk management, right? And people who work in model risk management are not the one who actually. I mean, model risk is part of everything. By the way, even during the development process, you also take care of model risk. But there are also dedicated professionals who take care of the models post production, and that's also known as model risk management. It involves quite a bit of reporting, but also monitoring, backtesting, and and recalibration, timely recalibrating models, and ensuring, there is something called margin of conservatism, assessing that on a regular basis and adding that on top of the model estimates, for capital calculations. All these activities are taken care of the model risk quants. Okay, and much more than that, by the way. And it can differ also. What happens in credit risk side would be very different from that in the market risk side, um, because the, the the problem is actually quite different. All right, so thanks for watching. Any doubt, let me know in the comment section, and thanks. I'll see you in another video.